We started short-term decision in our last class, and we said that short-term decision represents the application of marginal costing concepts to analyze a particular course of action in making managerial decision. Please mute, please mute. And we said that under short-term decision, whatever we want to do must be analyzed or examined critically in two perspectives. We are going to look at the economic perspective as well as the qualitative factor. And we said that the economic perspective represents the process of comparing the relevant cost of a course of action with the associated benefits, whether it will result in economic saving or deficit to the organization. Then we'll talk about the qualitative factors. The qualitative factor represents all the factors that cannot be expressed in monetary terms, okay? And we said that the quality of the decision-making by an organization will have a far-reaching effects on the business success in the marketplace, because bad decision can generally result in financial losses. It can also impair the ability of the company to take advantage of market condition. Not only that, bad decision can also erode the reputation of the organization. Therefore, it is just essential that any critical business decision that is to be taken should be immediately brought to the attention of the management, because this is necessary in order to receive the appropriate guidance from the decision makers, and also to avoid any bad decision being made, okay? And we went on to say that there are some areas in which marginal costing concept or technique can be used to aid managerial decision. I listed about 7 or 8 of them. One is the deleting of a segment. 2, make or buy decision. 3, acceptance or rejection of a special order. 4 is the shutdown of capacity. Then 5 is the pricing decision. We also have cost volume profit analysis. We use marginal costing concepts under optimal product mix. We also use marginal costing technique in making decision under linear programming. Then we went further to discuss about how to apply marginal costing under deleting of a segment. We said that deleting of a segment will generally arise basically when a particular segment is operating at a loss. Therefore, management may be contemplating on whether to discontinue the segment or not to discontinue it. And of course, we also said that we should look at, under deleting of a segment, that the decision will be looked into or will be examined in two perspectives. One is a qualitative perspective. So under deleting of a segment, we said the qualitative perspective to be looked into represents the process of comparing the cash inflows of the affected segments with the associated relevant costs, whether it will result in a positive or negative contribution using contribution margin approach or income statements. So these are what you need to do under quantitative perspective of the decision under deleting of a segment. So you just compare the sales value versus the relevant cost of making the components or of making the segments. Okay, and we also said that a segment could be a product, a type of customer, or geographical distribution or location, whatever it is. And I also provided you with a format under deleting of a segment. Then we said that the decision rule under deleting of a segment is that if it is positive contribution, the decision should be that the segment should not be deleted because the segment is actually contributing positively towards the recovery of the company's general fixed overhead and net profits. So, and then we said number 2, if it is negative contribution, the segment should be deleted because the negative contribution will generally worsen the financial performance of the organization. Therefore, the decision to discontinue the segments will then improve the company's overall net profits once it is deleted. Then we said the third decision area would be where there is zero contribution. So where there is zero contribution, that is, the total sales value will equate the total relevant cost of the affected segments. So when this happens, the company can either delete or not delete, depending on other qualitative factors. And we said the qualitative factors under deleting of a segment, I gave you a few of them, maybe 5 or 6, I can't remember. But we talk about the fact that the company will need to consider the impact of the closure decision on the company's turnover, okay, particularly where the targeted segments is jointly demanded with other products of the company. Then we also said that the company will also need to consider the impact of the closure decision on the company's reputation. Not only that, the perspective of the company's shareholder on the closure decision should also be taken into consideration. We also said the reaction and interpretation of the company's shareholder, of the company's creditors to the closure decision should also be considered. I remember I also mentioned the fact that the company will also need to examine and consider the need to take into consideration how the company will manage any negativity that may arise from the closure decision, including litigation from or compensation to the affected workers, because the workers' union, if the company decides to discontinue the segment, the workers' unions may rise against the company, they may protest, and every company will want to guard against anything that may impair their image. So as a result, and not only that, once the company decides that they want to delete that segment, then the company will also need to determine if they have the capacity, the financial capacity to pay the compensation to the affected workers. Not only that, those affected workers that are working within the segment that the company is contemplating to delete, what will be their fate? Okay, what will be their fate? Is the company going to redeploy them? If the company is going to redeploy them, and will there be any, the company will need to determine if there will be any staff training or retraining costs that will be incurred. And I remember I also mentioned that the company will need to consider the impact of the closure decision on workers' morale, especially as it affects productivity. You know, when you say once a company decides to delete a particular segment, knowing that this segment is being operated by some workers, so if you eventually delete that segment, Other workers that are working in other products or segments may become agitated because they don't know what their future holds within the company. Therefore, as a result, their morale will decline, will fall. That decision to delete that segment will lower the morale of the existing staff in other segments, and that will surely affect productivity. So these are the things we talked about under qualitative factor on deleting of a segment. And we had, I think, about 2 illustrations before we close the day. I can't remember except I go back to the recording for that day. So these are the things we discussed last time. I want to know, did I introduce you to make or buy decision? Please let me know.
Yes, sir.
Okay, I did, right?
Yes, sir.
Okay, so let me just let's talk. Yeah, let me just within the next 5 minutes, let me recap what we did under make or buy decision. Let me see. Is this being recorded? Yes, it is. Okay, so under make or buy decision, we said that generally in an organization, management may be thinking of management may want to know whether a particular raw material, sub-assembly, or component required to produce the company's final product should be manufactured internally or contracted to an outside supplier. This is because the decision of this nature can be critical and it can as well be strategic because of the need to protect the degree of secrecy underlying the company's product or the proprietary information associated with the company's product. So this is essentially important, especially in a business environment where competition is highly stiff. Okay, so as a result of that, there will be need for the company to protect the proprietary information, because once your competitor gets to know about the degree of secrecy underlying your products, the company may be out of the business. And that's why you have to ensure that before you make a final decision on whether you should make or buy a particular component or sub-assembly or raw material, you have to consider the degree of secrecy underlying the product or the component. Okay, so we now say that under make or buy, the most important thing to do is to analyze the components to be manufactured. Okay, considering the economic as well as the qualitative angle of the decision that is to be taken. And we said that under the economic angle, it involves the process of comparing the supplier's quotation with the relevant cost of making the components internally, whether it will result in economic saving or deficit to the organization. So generally under make or buy, when you want to analyze the economic angle of make or buy, the most important thing you need to do is to compare supplier's quotation versus the relevant cost of making the components, whether it will result in a saving or deficit to the organization. So I gave you the formats, and I also provided you with the decision rule. We said that if supplier's quotation is greater than the relevant cost of making the components, your decision should be that the company should make the product or the segment or the components. Number two, we talked about the fact that if supplier's quotation is less than the relevant cost of making the components, then the company should just buy because it is cheaper to do so. But where supplier's quotation equal relevant cost of making the components, the company can either make or buy the components depending on other qualitative factors. So the qualitative factors that you need to consider under make or buy include, number one, the company we need to consider. Let me share my screen with you. So that I'll be speaking. Okay. Let me open it. Oh, yeah. Okay. Look at this. Okay, shut down the sessions. Okay. Let me know if you can see my screen, please.
You
Yes,
can
very
see,
good.
I can see.
All right, thank you. So we are discussing make or buy decision. I gave you an assignment, none of you submitted. I gave you an assignment on cash and pick under deleting of a segment, and you did not submit. You did not even attempt it, let alone you submitting it. This is not good. You can't keep on.
I submitted mine, sir.
Who is speaking?
And you,
Yes,
Hosanna
Osana.
on the line.
Yeah, I know. I received that. I think only two of you submitted, you and one other person. You can imagine. That's not good enough. Huh? In any case, I will, after today, once we are done with short-term decision, I will forward the solution to cash and pick to you. Please, I'll be saying this all this while. It's not good for you. You can't be giving you an assignment and you refuse to do it. You don't have any excuse. A week after the assignment was given, you have not submitted. That's not good enough. You have to change going forward. Anyways, move on. So we are discussing the economic perspective of make or buy. Okay. And I said that one factor that you need to consider is that the company will need to ask that when you want to make, when you want to state your qualitative factors under make or buy, there are two angles you are going to look at it. One is that what are the relevant factors you must consider if you want to make the component internally? Two, what are the factors to be considered if you want to contract? If you want to contract the component to outside supplier to do it on your behalf. So you can take about 3 internally, then 2 or 3 if you want to outsource the components. Before you know it, you have about 5 or 6 or even more when you are asked to state your qualitative factors. So under make or buy decision, one key factors you must consider is that, say for example, if the company has the option to make the component internally, the company will need to ask itself some critical questions. One of those questions is that, do we have the required manpower to manufacture the components internally in addition to the existing products? So if the company has the manpower, then they may decide to make other than outsourcing it. Then two, these companies also need to ask itself whether it's permitted by law to manufacture the components in addition to the final products, because not all products are permitted in any country or in any state. For example, if you go to some northern states in Nigeria, you may not be allowed to rear pigs, okay? The law of the land may not permit you to do some certain businesses. So the company will need to ask itself if it's permitted by law to manufacture the components internally in addition to the company's final product. Also, the company will need to consider the need to maintain better quality control of the product or components, so that if you want to ensure that your customer get the best, it's important for you to manufacture the components internally yourself in order to guarantee the quality level of the product. Not only that, the company also need to consider the need to protect the degree of secrecy or the proprietary information or technology underlying the company's products, okay? Because, like I said earlier on, if your competitor get to know about it, the company may be out of the business, and that's why you have to guide it jealously. You will notice that in Nigeria, we have, in the lubricant industry, lubricant is the engine oil that you normally use. Some of them we use it for to run our generator. So there are different lubricants in the market. We have Mobil, we have Ohando, we have others. So many plethora of them. So why is Mobil more expensive than the others? It's because of the quality. And what makes Mobil lubricant to be unique or to be different from the others in the market is because of the mix of the components that make up the product. So if your competitor get to know about it, then the company will be out of the business. Sometime in 2017, February 2017 to be precise, Mobil Oil Nigeria, a subsidiary of ExxonMobil, divested from the downstream operation. It was the Mobil Oil Nigeria was sold to 11 PLC as at that time, 2017. So you can see up to today, you still be seeing the Mobil lubricant is still in the market. Not only that, the filling stations, the petrol stations, they are still operating Mobil. Even though 11 PLC is operating simultaneously with the Mobil, but they cannot change the name of Mobil because Mobil has a goodwill. Has a good name in the market. Almost customers, they know about Mobil products. And because despite the fact that ExxonMobil divested from Mobil Oil Nigeria, yet that name could not go out of the market, and the 11 PLC could not change immediately from Mobil to 11 PLC because they are going to run at a loss. So the Mobil lubricants is unique because of the mix that make up the product. So if that's uniqueness, that's thing that differentiates Mobil from other lubricants in the market is the proprietary technology, is the proprietary information, is the degree of secrecy that the company will need to protect so that your competitors do not get access to them. And if you say you want to contract to an outside supplier to do it on your behalf, how do you ensure that you protect that degree of secrecy? So these are the critical questions the company must ask itself before the final decision is taken. Not only that, if you decide to contract the component to outside suppliers, the company will also need to ask some vital questions. One is that, do we have a reliable supplier who can deliver according to specification? So, because if you have been producing previously and you now decide to contract it to an outside supplier, how do you ensure that you have a reliable supplier who can deliver according to specification? How you want your design to be? Your competitor, the external contractor or whatever, the supplier should be able to do it the same way you want it. All right. So you need to ensure you have that reliable supplier who can do that. Not only that, you also need to ask that, can the reliable supplier satisfy the existing capacity level? Okay, can the reliable supplier satisfy the existing capacity level? Now, if you say you need like 100,000 kg of that component, you should be able to get the 100,000 as requested. Not that the supplier will now tell you that, please, we are bringing 60,000 kg now. In the next hours, we are going to bring the balance of 40,000 kg. It doesn't work that way. That 40,000 balance may not come in few days, and this may disrupt the activity of the business. And that's why you need to ensure that you have a reliable supplier who can satisfy your existing capacity level. Not only that, you also need to ask yourself if the reliable supplier can offer a long-term arrangement. So if the company decides to contract it to an outside supplier to do it on its behalf, so you need to be sure that going forward, on a going concern basis, can this reliable supplier, okay, offer a long-term arrangement, okay? Not that after a few years down the line, there will be issue and won't be able to supply the company again. So before the final decision is taken, these are the critical questions the company will need to ask itself. Okay, so you can read it in your material. At this point, we need to move to calculation. Now, one thing we have discussed so far. Yes, Emeka, go ahead.
I just want to know, for the qualitative characteristics, how are we supposed to know, let's say, where the supplier's quotation equals relevant cost? How are we not supposed to know whether to make or buy after applying the qualitative?
No, you see, in this place, this is supplier's quotation versus relevant cost of making. If the two of them equal, so the company can either make or buy the components, depending on other qualitative factors. So what this means is that if it all depends on the factors that are available for the company to be considered, so it is just an option. The company will take a position. It's the company that will take a position. Management will take a position on what to do. So this is not a matter of, okay, if supplier's quotation equal relevant cost of making, how do we know whether we should make or buy? It's a position that a company must take. All right. So if you say if that is the case, decide, okay, it's better for me. Since I'm not saving anything in this situation, so it's better for me to just let me just make it. But before you make it, you need to ask yourself those germane questions, whether you have the expertise or technical know-how to produce the components in-house. Okay. So you have to ask yourself those questions. Yeah.
Oh, yes.
So let's move to illustrations. Okay, let me see. There are only two questions we are going to solve. Let me see. This number one. Okay, let's start small. Let's start small. All right. So let's start with illustration number one. Let me call one of you to read for us. Yes, Dorcas, can you please read?
Okay, sir. Hope Nigeria Limited is considering whether to manufacture or purchase a particular component, KP6. This would be in batches of 40,000, and the buying in price would be 26 naira per unit. The marginal cost of manufacturing components KP6 is 19 naira per unit, and the components would have to be made on a machine which is currently working at full capacity. If the component was manufactured, it is estimated that sales of 4,000 units finished product of EAS, which has a marginal cost of 240 naira per unit and sells for 320 naira per unit, will be lost. Required. Determine whether the firm should manufacture or purchase components KP6. B. As the management accountant of Hope Nigeria Limited, list 5 basic assumptions of cost volume profit analysis and identify 3 of its application.
Thank you very much, Dorcas. Now, as requested, you can see from this requirement, examiner is asking us to determine whether the firm should manufacture or purchase component KP6. So from this requirement, you can able to see the intention of the examiner. So this means that this question refers to make or buy decision, because the examiner is asking us to advise whether the company should manufacture or purchase components KP6. So if that is the case, the first thing we are going to do is to compare the supplier's quotation versus the relevant cost of making component KP6, whether it will result into saving or deficit to the to Hope Nigeria PLC. So if that is the case, without wasting more time, let me switch to the working notes so that we can quickly solve that and move to the next one. Okay. I believe you can see my working notes. Can you?
Yes, sir.
All right then. So the name of this company is Hope Nigeria PLC. Number A, you are required to advise whether the company should manufacture or purchase component KP6. Therefore, I will say saving or deficits from making components KP6. So we want to compare supplier's quotation versus the relevant cost of making the component KP6. I will then go back to the question, what is the supplier's quotation? So we are told in the question that Hope Nigeria PLC is considering whether to manufacture or purchase a particular component KP6. This will be in batches of 40,000 and the buy-in price will be 26 naira per unit. That buy-in price represents the supplier's quotation, 26 naira per unit. The marginal cost of manufacturing component KP6 is 19 naira. So what that means is that if there are no other information, I will just compare the buy-in price of 26 naira with the marginal cost. Marginal cost is the same thing as direct cost or variable cost. So of 19 naira. So I'll now make a point, make a decision. But you are given further information. We're now told that the component would have to be made on a machine which is currently working at a full capacity. If the component was manufactured, it is estimated that sales of 4,000 units of finished product of Heinz, which has a marginal cost of 240 naira per unit and sells for 320 naira per unit, will be lost. So if not because of this last paragraph, I would have calculated my savings or deficits using power value. That is, I will just compare 26 naira with 19 naira, then I will make the final decision. But as a result, examiner has told us that if the component is manufactured internally, the company estimated that 4,000 units of finished product of Heinz that has a marginal cost of 240 naira and sells for 320 naira will be lost, meaning that the company will lose contribution. If the company manufactured a component internally, there will be contribution loss of 80 naira per unit. That is 320 naira of the selling price minus marginal cost of 240 naira. That's 80 naira contribution. Okay, so I will now multiply the 80 naira contribution with 4,000 units of earnings. So whatever I have will give me, in addition to the marginal cost that I have in the fourth paragraph. So because of this additional information, I cannot use par value. Rather, I'm going to use absolute value. Therefore, I will then proceed to say, supplier's quotation, how many units do you want supplier to supply you? 40,000 of the products, component KP6, then multiply by supplier's quotation of 26 naira. So, from your calculator, what do we get? What do you get? 40,000 multiplied by 26 naira.
140,000.
1,040,000.
1,040,000. Good. So this is supplier's quotation. I need to compare this with relevant cost of making component KP6. So relevant cost of making. Remember, from the format given to you, under the relevant cost, you have direct material, direct labor, direct expenses, variable overhead, opportunity cost, specific, attributable, direct or incremental fixed cost. Any cost that is relevant to the component that you want to manufacture internally, you have to consider it under the relevant cost. So in this question, examiner has given us marginal cost, which is variable cost. They have matched everything together. The direct material, direct labor, direct expenses, variable overhead has been added together to have the marginal cost. And we are told that the marginal cost is 19 naira per unit. So I would then say marginal cost, which is 40,000 multiplied by 19 naira. What do you have?
760,000.
760,000. Let me just put it here. 760,000. Then there's an additional information in the second paragraph where we are told that if the component was manufactured, it is estimated that sales of 4,000 units of finished products of ENS, which has a marginal cost of 240 per unit and sells for 320 naira per unit, will be lost. So there will be contribution loss of 80 naira per unit. So I need to multiply the 80 naira by the 4,000 units of the finished goods of ENS that will be lost. So if that is the case, I would then say I can call it contribution loss or opportunity cost. So contribution loss of 4,000 units multiplied by 80 naira, multiplied by 80. The 80 naira, let me write this. The 80 naira is gotten by deducting the selling price of 320, deduct 240 from 320. Okay, so what do you now get? 80 multiplied by 4,000 units. That should be 320,000.
320,000.
Okay, 320,000. So add the two together. Since there is no additional 1,080,000. So this represents the total relevant cost, which is B. So at this point, we need to make a decision. We said that if A is greater than B, the company should make. But if A is less than B, the company should buy. So in this question, supplier's quotation is 1,040,000 naira. Relevant cost of making component KP6 is 1,080,000 naira. So supplier's quotation is cheaper. Therefore, the company should manufacture component KP6. So I would then say, Hope Nigeria PLC should manufacture components, should purchase. That's what I wanted to say. Hope Nigeria PLC should purchase components KP6 in order to save 40,000 naira. Okay, in order to save 40,000 naira. That's it, difference between 1,080,000 and 1,040,000. Okay, that's that. So what else in that question? So number B, examiner is asking you about cost volume profit. So it's a topic when we get to, I can't give you answer to this one now. When we get to cost volume profit analysis, you need to understand some basic things before we can be talking about this. All right, so skip this one till then. So that's that. So at this point, let's move to another illustration. Before we move to another illustration, let me know if you have any question on this. Any question for me? All right then. So in the absence of no further question, let's move to another illustration. So let's go to illustration number 2. We are going to solve 3 illustrations. So all the 3 illustrations we have there, we are going to solve. So let's move on. Let me stop on the share. Okay. Who wants to read illustration number 2 for us? Let me look at. Somebody came late. Yes, there must be consequence for coming late to class. Lizzie, Elizabeth, I did not see you when we started. Oh, yeah, read.
Okay,
Lizzie.
sir.
Okay.
Good evening, sir.
Good evening.
Yes, sir. Shangote, illustration number 2. Shangote Nigeria Limited produces and sells to wholesales a highly successful line of summer lotion and insects. Sorry, I'm just using my glasses. Sorry about that.
It's okay.
And insect repellent has decided to diversely in order to stabilize sales throughout the year. A natural area for the company to consider is the production of lotions and cream to prevent dry and chapped skin. After considerable research, a product has been developed. However, because of the conservative nature of the company management, Shangote management has decided to introduce only one of the new products for the coming season. If the product is a success, further expansion in future years will be initiated. The product selected called Sharp Off is a lip balm that will be sold a lipstick type tube. The product will be boxed. Because of the available capacity, no additional fixed charges will be incurred to produce the products. However, 100,000 fixed charges will be absorbed by the products to indicate fair share of the company present cost to the new products. Using the estimated sales and production of 100,000 boxes of a sharp off as the expected volume, the accounting department has developed the following costs per box. Direct material 3.0, direct labor 2 naira, total overhead 1.5, total of 650. Dangote Nigeria has approached a cosmetics manufacturer to discuss of purchasing the tubes for sharp off. The purchase price of the 24 empty tubes in a box from the cosmetics manufacturer is 90 kobo. With the purchase proposal, it is predicted that direct labor and variable overhead costs will be reduced to 10% and direct material costs will be reduced to 20%. Required. Okay. Okay. Required. Should Shangote Edo Nigeria Limited make or buy the tubes? Show calculation to support your answer. Question 2. What would be the maximum purchase price acceptable to Shangote Edo Nigeria Limited for the tubes? Show calculations to support your answer with an appropriate explanation. Instead of sales of 100,000 boxes, revised estimate shows sales value of 125,000 boxes. At any volume above 100,000 boxes, additional equipment of an annual rental of 10,000 naira must be acquired. Under these circumstances, should Shangote Edo Nigeria Limited make or buy the tubes? Show calculations to support your answer.
Number 4.
Hello, sir. Number 4.
Yeah.
Okay, sir. The company has the option of making and buying at the same time. What would be your answer to requirement 3? If this alternative were considered, if this alternative were considered, show calculation your answer.
Thank you very much, Lizzie. That's
Thank
the
you, sir.
question. Okay, you can then mute yourself. So, you can see from the requirements, requirement 1, examiner says, should the company make or buy the tube? So, which means that this company relates to make or buy. So, I don't need to waste time on this. We go straight to solving it. Let me switch to the working notes. Okay. So, the name of this company is Shangote Edo Nigeria Limited. Illustration. Solution to illustration number 2. Shango Edo Nigeria Limited. So examiner is asking in the first requirement whether the company should make or buy the tubes. So what we need to do is to compare supplier's quotation versus the relevant cost of making the tube. Therefore, I would then say number 1, saving or deficits from making the tube. Okay. So in this case, I will compare the supplier's quotation versus the relevant cost. I will go back to the question. What is the supplier's quotation? So when you look at after the 6.5, there's a paragraph that follows. We are told that Songotedo Nigeria Limited has approached a cosmetic manufacturer to discuss the possibility of purchasing the tubes for chap-off. The purchase price of the 24 empty tubes in a box from the cosmetic manufacturer is 90 kobo. So supplier's quotation is 90 kobo. So we need to compare relevant costs of making the tube. So we're now told that with this purchase proposal, it is predicted that direct labor and variable overhead costs will be reduced to 10% and direct material costs will be reduced to 20%. So supplier's quotation is 90 kobo. So let me go and indicate that. So I would then say, if I want to use, I can decide to use absolute number or I use power value in this question. I'm at liberty to either use absolute number or power value. Whichever one I use, I'm going to get the same decision. So if I want to use absolute value, I will just multiply 100,000 boxes, multiply by 90 kobo. So that will give me 90,000 naira. If I want to use power value, I will just put 0.9. But in this case, I'm using power value. So that will save me time, 0.90. Move on. So I need to compare this with relevant cost of making the tube. Relevant cost. I will then go back to the question. Am I given direct material? Yes, there's a direct material in the table. There's a direct material of 3 naira, direct labor of 2 naira, total overhead of 1 naira 50 kobo. I'm looking for relevant cost. Therefore, I would then say direct material, 3 naira. 3 naira, you can see 3 naira is even more than the supplier's quotation of 90 kobo, let alone including direct labor. So as it is, that 3 naira is not the relevant cost we are looking for because examiner, that 3 naira is based on the 100,000 boxes originally that the company has. The 100,000 boxes the company has originally. But examiner has told us in the last paragraph that with this purchase proposal, it is predicted that direct labor and variable overhead costs will be reduced to 10%, and direct material costs will be reduced to 20%. So direct material is supposed to be reduced to 20%. So let us go and make the adjustment. So I would then say direct material. Direct material, which is 3 naira. Examiner told us it will reduce to 20%. So multiply by 20%. So this will give me 0.6. So this will give me 0.6, 0.60. Close this. Then I will go back to the question. I have direct labor. Again, we are told that direct labor will be reduced to 10%. Okay, direct labor and variable overhead will be reduced to 10%. So I will then come here. How much is direct labor? Direct labor is 2 naira. So here is 2 naira multiplied by 10%. So that should be 0.2. Here is 0.20. So examiner also mentioned that variable overhead will be reduced by 10%. But in this question, the examiner did not give me variable overhead. I can't find variable overhead anywhere in the question. Examiner only gave me total overhead. So what this means is that I have to push myself out of the box, because when you say total, when you are given total overhead is not relevant. When you are talking about relevant costing, total overhead is not relevant. There are 2 types of overhead. So only the variable overhead is relevant. The fixed overhead is not relevant because whether you undertake the course of action or not, you are going to incur your fixed overhead. So, and that's why only the variable overhead is relevant. So, but in this question, examiner did not give the variable overhead. So you need to scan through the question and see if you know that total overhead equal variable and fixed overhead, and you can't see variable overhead anywhere, then I should be able to see something that relates to fixed overhead. So when you look at this question, I think in the second or third paragraph, yes, in the third paragraph, examiner has given you the information by telling you that in the second line, because of the available capacity, no additional fixed charges will be incurred to produce the product. However, 100,000 naira fixed charges will be absorbed by the product to indicate fair share of the company's present fixed cost to the new product. Using the estimated sales and production of 100,000 boxes of chop-off as the expected volume, you can see examiner has given you the fixed overhead to be 100,000 naira at activity level of 100,000 boxes. Therefore, what that means is that I need to go and calculate my fixed overhead. Once I get my fixed overhead, I will less it from the total overhead. The difference will give me the variable overhead. Now, this is what I'm saying. Let me go and do my working. I will leave this page, then move to the third page for our working. Okay, so working number one, I want to determine variable overhead. So to get the variable overhead, I will pick the total overhead. Examiner has told me that total overhead is 1 naira 50 kobo. And I said that this total overhead is irrelevant. The only variable overhead is relevant. But because we are not given variable overhead, but in the question examiner gave us fixed overhead. Therefore, I would then say fixed overhead per unit is equal to 100,000 naira . 100,000 naira divided by 100,000 boxes. Okay, that's 1 naira. The fixed overhead is 1 naira. So 1 naira minus 1 naira 50 kobo will give us 0.5. Will give us 50 kobo. This is variable overhead. Now that you have the variable overhead, we can then proceed with our calculation. So I will then say variable overhead working number one is calculated as 50 kobo. We are told that variable overhead will reduce by 10%. So multiply by 10, which is 5 kobo, 0.05. So let's go back to the question. Any other information? No other figures. So that's it. So at this point, we need to add it together. So that will give us 0.85. This represents the total relevant cost per tube. Total relevant cost per tube. So here is A, here is B. With this, what are we supposed to do? Examiner is asking us in the question, should Songote Edo Nigeria Limited make or buy the tubes? So you can see, surplus quotation is 19 kobo per tube. Relevant cost of making the tube is 85 kobo. Therefore, the company should make the tube. I would then say the company should make the tube. Okay. Since the total relevant cost per tube of 85 kobo is lower than the supplier's quotation of 90 kobo. So there's no need for too much of wordings. All right, so that's that. We are done with number one. Let's move to the next one. Number two, what will be the maximum purchase price acceptable to Shangote Edo Nigeria Limited for the tubes? Show calculation to support your answer with an appropriate explanation. What will be the max? Examiner is asking, what will be the maximum purchase price acceptable to the company? Okay, acceptable to the company. You know, something that costs you 85 naira, 85 kobo. Can you accept anything higher than that? Answer me. Something that costs you
No, sir.
85 naira, 85 kobo. Can you pay anything higher than 85 kobo?
No, sir.
No. So and that's why examiner is asking you to advise whether it is financially or examiner is what will be the maximum purchase price acceptable to the company. Okay, so I would then say we've already done this, but since the examiner is saying you should show your calculation, then you need to write it out. So I would then say number two, the maximum purchase price acceptable to Shangote Edo Nigeria Limited is 85 kobo, representing the total relevant cost of making the tube. Okay, as shown in the calculation below. Okay, then I will now write the relevant costs. So I will then say relevant cost or simply say maximum purchase price. Maximum purchase price. Okay. So the first item is direct material, which is 60 kobo. Direct labor, 40 kobo. Variable overhead, 5 kobo. When you add up 0.85, that's it. So let's move on to the next one. Number three, instead of sales of 100,000 boxes, the revised estimate shows sales volume of 125,000 boxes. At any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should Shangote Edo Nigeria Limited make or buy the tubes? Show calculation to support your answer. So what the examiner is saying here is that, you know, currently the activity level is 100,000 boxes, but we're now told that revised estimate shows the activity level of 125,000 boxes, and that at any point above 100,000 boxes, the company will need to acquire an annual, we need to pay annual rental costs for additional equipment at 10,000 naira. So under this situation, can we say the company should make or buy the two? So what we need to do here is to compare supplier's quotation versus relevant costs of making 125,000 boxes. So at this point, I would then say number three. Number three, so I would say saving or deficits from making 125,000 boxes. So I would then come here, supplier's quotation we have 125,000 boxes multiplied by supplier's quotation of 90 kobo. Somebody should give me the answer. What do you get?
112,500.
112,500. Thank you. So that represents supplier's quotation. So I need to compare this relevant cost of making the 125,000 boxes. So I have direct material. So direct material is 60 kobo. I would then say 125,000 multiplied by 60 kobo. What do you get?
75,000.
Thank you. 75,000. I also have direct labor. 125,000 multiplied by 20 kobo. What do you get?
Yes. 25,000.
25,000 naira. We have variable overhead. 125,000 activity level multiplied by 5 kobo. What do you get?
6,250.
6,250.
50.
Examiner now told us that there's a rental cost of 10,000 naira for equipment, that we are told that at any point above 100,000 boxes, the company will need to purchase an equipment, additional equipment at a rental cost of 10,000 naira. So since we are making 125,000 boxes, therefore, there will be equipment rental. So equipment rental of 10,000 naira. Therefore, add them together, what do you get?
116,250.
116,250. So that represents the total relevant cost of making 125,000 boxes. So examiner is now asking us, should the company make or buy the boxes? You can see supplier's quotation of 112,500 naira is lower than the relevant cost of making the 125,000 boxes. So our advice should be that the company should buy the boxes. Okay, I would then say, oh, we've exhausted the, okay, no worry. Let me just put it there. So decision. The company should purchase the 125,000 boxes. Okay, that's it. You can stop there. Okay, so that's that. So let's go to number 4. the company has the option of making and buying at the same time. What would be your answer to requirement 3? If this alternative were considered, show calculation to support your answer. Okay? So examiner is asking us, the company has the option of making and buying at the same time. So guys, what do you think we should do? The company has the option of making and buying at the same time. What do we do in this requirement number 4? Talk to me. The company has the option of making and buying at the same time. So an examiner is referring to requirement number 3. You know, in the requirement number 3, you are supposed to make 125,000 boxes. So there is an activity level of 125,000 boxes. So examiner is now asking you now, the company has the option of making and buying at the same time. What are we supposed to do?
Good evening, sir.
Good evening. Who is speaking?
This is Esther, sir.
Esther, okay. Talk to me.
Yes, sir. So I think, to me, I feel like the company should produce 100,000 units and then buy the remaining 25,000 units from the supplier.
Why?
Yes, because for the production, there is a profit. And the major thing is the equipment rental. That is what increased the costs in the production of 125,000 units.
Okay. All right. Thank you very much. You are correct. Because at 100,000 boxes, the price per box is 85 kobo. If not because of the equipment rental of 10,000 naira, it could have been cheaper for the company to make. So just like Esther said, we are going to produce, the company will produce 100,000 boxes internally. The balance of 25,000 will be purchased from outside supplier. What that means is that the company will skip, we avoid the 10,000 naira of equipment rental. Okay, so let's indicate that in our solution. Mute, please. Number 4. Okay. So in this number 4 requirement, we are told that the company has the option of making and buying at the same time. So there are 3 scenarios that will play out. Option number 1. Option number 1. The company can decide to buy the entire 125,000 boxes. Okay. Buy 125,000 boxes at 90 naira per box, which is equal to 112,500 is what we got. Option number 2. In option number 2, the company can decide to make 125,000 boxes, okay, at total cost of 116 naira 250. Is it? Let me confirm. Yes, 116,250. Then option number 3. The company can make 100,000 boxes at 85 kobo per box. When you multiply that with 100, that will give us 85,000 naira. Then the company will buy the balance of 25,000 boxes from outside supplier at 90 kobo. So this should give us what? What do we have? Use your calculator, please. 90 kobo multiplied by 25,000 boxes. What?
22,500.
22,500. When you add the two together, that's 107,500. So this is option to buy and make. The company has the option of making and buying. So here is option, making. So the question is saying that the company has the option of making and buying. All right. So I would then say option to make and buy 125,000. You can see it is cheaper. If the company decide to buy the entire 125,000 from outside supplier, the company will incur 112,500. If the company decides to make the entire 125,000 boxes, the company will incur 116,250. But if the company buy 100,000 boxes at 85 kobo, then sorry, the company make 100,000 boxes at 85 kobo and buy 25,000 boxes at 90 kobo. Total will be 107,500, which is cheaper. All right. So this is what examiner wants us to do, and that's that. So if you like, we can then go further to say the company should make 100,000 boxes at 85 kobo and buy 25,000 boxes at 90 kobo per box. Okay. At a total cost, if you like, you can go for that to say at a total cost of 107,500 naira. That's it. That's end of the question. That's end of the question. Go through it. Let me know if you have any question or any concern so that we can move to the next one. Do you have any question for me? Okay, so if not, let's have one more illustration. I would have moved to the next one, which is acceptance or rejection of a special order. But this particular question, we need to solve it because it has to do with you are given cost of capital in the question. So let me expose you in case you are given this kind of a question again in your exam. So how do you treat it? All right. So let me go back to.
Excuse me, sir.
Hello.
Yes, sir. Rosanna is speaking.
Yeah, Rosanna, talk to me.
Sir, what's the difference between attributed fixed overhead and variable fixed overhead?
Variable, there's nothing like variable fixed overhead. We have variable overhead, we have fixed overhead. There's nothing like variable fixed overhead.
Attributed fixed overhead.
Pardon?
Attributed, is there anything like attributed fixed overhead?
There is attributable. When you say a fixed cost is directly attributable, that is, it is related to the product. When something is attributable, it means that it is specific. You can trace it to that product. So examiner can call it specific fixed cost, attributable fixed cost, direct fixed cost. So it could be called any name. All right. So, and then attributable fixed cost is a relevant cost. You have to consider it.
Okay.
So, but
right.
in fixed cost, there are three ways examiner can test you. You can mute yourself. There are three ways examiner can test fixed cost in a question. If you are given a fixed cost, just fixed cost, no further information, it means that that fixed cost is irrelevant. Okay. If there is no further, you are just given fixed cost, no further information, that fixed cost is irrelevant. You ignore it in the determination of relevant cost. Okay, but if you are told that fixed cost, including depreciation, examiner tells you that fixed cost, including depreciation, what that means is that examiner wants you to do something. So you need to go ahead and determine annual depreciation. Once you calculate your annual depreciation, you less it from the fixed cost. Whatever you have thereafter is a relevant fixed cost you must use. The third way examiner can test you under fixed cost is you may be given fixed cost. Examiner can say fixed cost excluding depreciation. If you are given a fixed cost that excludes depreciation, that fixed cost is relevant. You have to account for it. You have to take it. Remember, depreciation is a non-cash item. So if your examiner is now telling you that fixed cost excluding depreciation, it means that fixed cost is relevant. You have to account for it. So these are the three ways in which examiner can test you under fixed cost. Okay. So let's go to let's have one more illustration under this. So what that means is that in our next class, we just go straight to acceptance or rejection of a special order. Then thereafter we move to I will introduce you to optimal product mix decision. Okay. All right. So let's have this illustration number 3, divine grace. Again, who will be reading for us? Lizzie has read, Dorcas read. Then let me look for a guy. Victor, can you please read for us?
Okay, sir.
Thank you.
Divine Grace DG Limited currently makes as many units of parts 2011 as it needs. The company has recently received a bid from another company, KKPSC, for making parts 2011. The company will supply 1,000 units of part 2011 per year at 100 Naira a unit. The company can begin the supply and continue for 5 years, after which time DG Limited will not need the parts. KKPSC can accommodate any change in DG Limited's demand for the parts and will supply it for 100 Naira regardless of quantity. Ayo Ayuba, the cost accountant, reports the following costs for manufacturing 1,000 units of part 2011. Direct material 44,000, direct production labor 22,000, variable production overhead 14,000, depreciation on machine 20,000, product and process engineering 8,000, rent 4,000, general overheads 10,000. Total is 122,000. The following additional information is available. 1. Part 2011 is made on a machine used excessively for the production of part 2011. The machine was acquired on January 1st last year at a cost of 120,000. The machine has a useful life of 6 years and 0 terminal disposal price. Depreciation is calculated on the straight line method. 2. The machine could be sold today for 30,000. 3. Product and process engineering costs are incurred to ensure that the production process for part 2011 works smoothly, although these costs are fixed in the short run. With respect to units of part 2011 produced, they can be saved in a long run if part 2011 is no longer produced. If part 2011 is outsourced, product and process engineering costs of 8,000 will be incurred for next year only. Rent costs of 8,000 are apportioned to products on the basis of the floor space used for manufacturing the products. If Part 2011 is discontinued, the space currently used to manufacture it will become available. The company could then use the space for storage purpose and save 2,000 currently paid for outside storage. General overheads are apportioned to each department on the basis of direct production labor costs. This cost will not change in total, but no general overhead will be apportioned to Part 2011 if the part is outsourced. Assume the required rate of return is 12% required. A. Should DG Limited outsource Part 2011? B. What maximum price should KK Limited quote on the 1,000 units to make Divine Grace indifference between outsourcing and internal production? C. What non-financial factors will favor internal production rather than outsourcing?
Thank you very much, Victor. That is the question. Okay, that is the question. So in the A part, examiner is asking, should DG Limited outsource Part 2011? So this tells us that this question relates to make or buy decision. So, but what makes this question to be unique relative to what we have done previously is the fact that examiner has given us a rate of return of 12%. So if you are given a cost of capital of 12%, it means that you are supposed to discount the future cash flows to the present value equivalent before you determine savings or deficits from making Part 2011. So to solve this question, there are about 3 or 4 stages that you are going to undertake. The first one is for you to be able to bring out the variables that you need under, if you want to outsource Part 2011, what are the relevant variables you have in the question? Because it's more than one variable. According to this question, there will be more than one variables that relates to supplier's quotation. Then also, if you decide to make the components, of Part 2011 internally, what are the relevant costs that the company will incur? So once you have determined the variables that you need under outsourcing and the variable that is needed or that are needed under internal production, then you then go ahead to discount those variables to the present value equivalent. So the present value of outsourcing minus the present value compared with the present value of internal production. Anyone that has a lower present value of cost will represent the option that the company will take. So if that is the case, of course, let's go ahead and solve this question. I will stop sharing the question so that I can move to the working notes. Okay. So the name of this company is Divine Grace Limited. So I will say Divine, before that, solution to question number 2, illustration 3. Divine Grace Limited. So there are 2 options. Okay, let me just give you some intro. This question relates to make or buy decision. However, Since a cost of capital, let me write it in full. Is given, comma, there will be need. There will be need. There will be a need. There will be a need to discount the future cash flows under outsourcing and internal production. To the present value, discount to the present value equivalent before determining savings or deficits from making Part 2011. This is shown as follows. Okay, so at this point, we need to go back to the question. Let us bring out the variables that we need. Say, for example, there are two options in this question. We have option one is to outsource Part 2011. So option one, outsourcing Part 2011. So what are the variables that we need if we want to outsource Part 2011? Let's go back to the question together and bring out the variables that we need. So let's read the question together. Okay. Yes. We are told that Divine Grace Limited currently makes as many units of Part 2011 as it needs. What this is saying is that currently the company makes Part 2011. The company has recently received a bid from another company, KK PLC, for making Part 2011. The company will supply 1,000 units of Part 2011 per year at 100 Naira a unit, meaning that the suppliers, KKPLC is the supplier. So KKPLC will supply 1,000 units of Part 2011 per year. So let us go and indicate that. So I will say supply 1,000 units of Part 2011 at 100 Naira per year. Let me confirm that. Is it per year? What did I say? Yes, per year. So if that is the case, so I will say per year. So I will then multiply 100 Naira multiplied by 1,000 units will give us 100,000 Naira. Okay, so supply cost. The supply cost of 100,000 units is 100,000 Naira per annum per year. Okay, so what I mean is that if the period of this contract is more than 1 year, so we need to discount it based on the number of years that you have. So that's number one information we have gotten under outsourcing. So let's go back to the question. The company can begin the supply and continue for 5 years, after which time DG Limited will not need the parts. KK PLC can accommodate any change in DG's limited demand for any parts and will supply it for 100 naira regardless of the quantity, meaning that whether DG require less than 1,000 units or even more than 1,000 units, the KKPSC will still charge 100 naira per unit. So that's just for information purpose. But one key information that is clear under the supply is that this supply will take for 5 years. Okay, so this will be for 5 years. So you need to account for that. I can change this one for the okay. That one is still valid per year. So I will then go further. Remember, this supply will take for the next 5 years. So we need to account for that when we are calculating our discount factor. So let's go back. Ayuba, the cost accountant, report the following cost for manufacturing 1,000 units of part 2011. Okay, so if the company wants to manufacture part 2011, these are the costs that the company will incur. So let us go and create another line for option 2. Let's option 2, we start from the following page. So here is option 2. Under option 2, this represents option to make. The company wants to make it. So this is internal production. Internal production. So that's option 2. What are the relevant variables that we need to consider under option 2? So we have direct material. So direct material is relevant cost. You know, when you want to produce, your focus should be on the relevant cost. So we have direct material of 44,000, direct production labor of 22,000, variable production overhead of 14,000, depreciation of machine. Depreciation is a non-cash item, therefore irrelevant. Product and processing engineer. Product and processing engineer may be irrelevant, but examiner has told us something in note number 3, that product and process engineering costs are incurred to ensure that production process for part 2011 works smoothly. So what that means is that if the company does not incur product and process engineering, there may be disruption in production process. Therefore, that product and processing engineering of 8,000 naira is relevant. You have to account for it. Rent of 4,000. Rent is a fixed cost, except it is incremental in nature. Let's go to note number 4. You are told that rent cost of 8,000 naira. Rent cost of 8,000 naira are apportioned to products on the basis of the floor space used for manufacturing the product. If part 2011 is discontinued, the space currently used to manufacture it will become available. The company will then use the space for storage purposes and save 2,000 naira currently paid to outside storage. But our focus now is that we want to know, if you want to manufacture part 2011, will the company incur rental costs? Of course, the company will not incur rental costs, so it is not part of the cost the company should consider. Therefore, you ignore the rental cost. Then, so what that means is that of the next one, which is general overheads. General overhead is irrelevant because whether you manufacture part 2011 or not, the company will incur general overheads. So rent is irrelevant, but general overhead of 10,000 naira is also irrelevant. Therefore, only direct labor, direct material, direct production labor, variable production overhead, and product and process engineering are relevant. Let's quickly put it down. So we have the raw material, which is, how much is that? 44,000. Here is 44,000. Direct production labor, 22,000. Next item, we also have variable production overhead, 14,000. Variable production overhead, 14,000. Finally, we have products and process engineering costs. Of 8,000. So these are all the relevant costs that the company will incur if the company wants to manufacture part 2011 internally. So if that is the case, I can decide to add them together to know the total relevant costs that the company will incur to manufacture part 2011. So 44 plus 22, that's 66. 66 plus 14, that's 80, 88,000. So per annum, 88,000 per annum. Okay. All right. So if that is the case, so let's continue with the information. Let's go back to the additional information. The following additional information is available. The following additional information is available. So you are now told that part 2011 is made on a machine used exclusively for the production of part 2011. The machine was acquired on 1st January last year at a cost of 120,000 naira. The machine has a useful life of 6 years and zero terminal disposal price. Depreciation is calculated on a straight line basis. That information is irrelevant. Okay, that information is irrelevant. Examiner is only telling you how they arrive at that depreciation on machine of 20,000 naira. You know, when you divide 120,000 naira by 6 years, so it will give you 20,000 naira per year. So examiner is explaining to you how they got the 20,000 you have in the table. So information number 1 is irrelevant. Move to number 2. The machine will be sold today for 30,000 naira. So if KPSC wants to sell this machine, they are going to receive 30,000 naira today. If they want to sell it today, today means now, and now means year 0. So let us go and account for that. I would then say savings. There is a savings from machine disposal. I will say machine disposal. That is savings. How much? We are told is 30,000 naira. So I will then come here, 30,000 naira. When are they going to make these sales? Now. Now means year 0. Year 0. Because we are talking about time value of money. So that's year 0. So that when we are discounting, we know when to account for the savings of 30,000 naira. Let me put this one here because of space. Let me rewrite this. At year 0. Now, so that when we are picking our numbers, we know what year to put for our discount factor. Let's go back. Then number 3, product and process engineering costs are incurred to ensure that the production process for part 2011 works smoothly. Although these costs are fixed in the short run with respect to the unit of part 2011 produced, they can be saved in the long run if part 2011 is no longer produced. If part 2011 is outsourced, products and process engineering costs of 8,000 naira will be incurred for the next year only. So if it is outsourced, the company will incur product and process engineering costs of 8,000 naira. So let's go and account for that. Number next, under the outsourcing, products and process engineering cost, we are told is 8,000 naira. In year one, let me go back there again and check. Process and it will be incurred for the next year only. For the next year only, meaning year one only. Okay. Next year. So at year one only. All right. These are just variables, not the main calculation. So let's go back to our notes. Note number 4. Rent cost of 8,000 naira are apportioned to products on the basis of the floor space used to manufacture the products. If part 2011 is discontinued, if part 2011 is discontinued, the space currently used to manufacture it will become available. The company could then use the space for storage purposes and save 2,000 naira currently paid for outside storage. So there is another information there. Examiner has told you that there is a storage space. Okay, so if that space is no longer needed, the company can save 2,000 naira per year. So I will say storage space. Number 4, storage space saving of 2,000 naira per year. Okay, per year. So what that means is that since the useful life of this contract will take for the next 5 years. That means the one that is per year will be incurred for the next 5 years, or will be saved for the next 5 years. So if that is the case, let's go back finally and number 5, general overhead are apportioned to each department on the basis of direct production labor cost. This cost will not change in total, but no general overhead will be apportioned to part 2011 if the part is outsourced. So that means it's irrelevant. We ignore it. So if that is the case, now we have identified all the relevant variables that we need to solve this question. So under outsourcing, we identify 4 variables. The first variable is the supply cost of 100 naira per 1,000 unit that the company wants to supply, the supplier wants to supply to the company. So which is 100,000 naira per year. So I need to discount this 100,000 naira per year because the period of this contract is the next 5 years. Therefore, 100,000 naira for year 1, 100,000 naira for year 2 up to year 5. So I will just calculate annuity factor. I will multiply with 100,000 naira. It will give me the present value under supply cost. Again, the second one under outsourcing is machine disposal. There is a saving of 30,000 naira now. Now means year 0 immediately. So if that is the case, I need to discount this 30,000 naira at year 0. Discount factor at year 0 is usually 1. Therefore, there's a saving of 30,000 naira now under if this machine is disposed. Then the third variable we have under outsourcing is the product and process engineering cost. So which of course 8,000 naira for year 1 only. Then of course we have storage space. That's a saving on storage space of 2,000 naira per year for the next 5 years. So I will calculate annuity factor on that. So I will add up all the present value together for outsourcing. Whatever it is, I will keep it on one side. Then I will then go ahead and calculate the present value under internal production. I know that the total relevant cost that this company will incur, that Divine Grace will incur under internal production is 88,000 naira. So since 88,000 naira is constant, year 1, 88,000, year 2, 88,000, up to year 5, 88,000. Therefore, I need to calculate annuity factor, okay, to discount the 88,000 for the next 5 years. Whatever it is, I'll put it on the other side. Then the third procedure for me is for me to get the to determine savings or deficits from outsourcing or making per 2011 internally. So that is that. Let us go ahead and solve this question straightforward. I would then say calculating present value of outsourcing part 2011. We want to determine the present value of outsourcing part 2011. When you want to calculate your present value, when we get to capital budgeting, I will be explaining to you what present value is all about. Okay, so how do you determine your NPV, payback period, internal rate of all these things? When we get to capital budgeting, we are going to discuss it in details. But for now, let's solve this question as it is. So to get the PV, to get the present value, we are going to create a column for year. You are going to have description of items. Then we are going to have cash flow. Let me increase that space. So we have cash flows. Then we are going to have a discount factor at 12%. Then we are going to have present value. So this is the format. Now, I will then go back to under outsourcing. Under outsourcing, we have supply costs. So I will then say supply costs. Supply cost. The supply cost per year is 100,000 naira. Supply cost per year is 100,000 naira. How many years is KKPSC going to supply DG Limited? We are told 5 years. Therefore, since 100,000 naira is constant, every year is 100,000 naira. Therefore, I need to go and calculate annuity factor of year 1 to 5. So let me show you the formula for calculating annuity factor. Let's go to the third page. So working. When you want to calculate annuity factor, annuity factor is calculated when you have constant cash inflow. Okay, so AF, annuity factor. It can also be called cumulative discount factor. So annuity factor is calculated as 1 minus 1 plus cost of capital raised to power minus n. Raised to power minus n, all divided by r. So in this question, the cost of capital given to us, which is r, is equal to 12%. Therefore, I would then say 1 minus 1.12, because our r is 12%. So 12% is the same thing as 0.12. So 0.12 plus 1 will give us 1.12. N is the useful life of this contract. The useful life, the contract will take 5 years. Okay, the contract to supply per 2011 will take 5 years. Therefore, minus 5. Divided by the cost of capital of 12%. So let's do it together. Carry your calculator. Let me carry my own. Let's confirm the figure. Okay. So I have, when you want to do this, I will say 1.12 raised to power 5 minus equal, then minus 1 equal, divided by 0.12 equal. I got 3. Okay, then. So this will give us 360,500, 360,500. So I'm done with that. I would then go back again to under outsourcing. The second item is disposal, matching disposal. There is a saving of 30,000 naira now. Now means year 0. Therefore, we need to do an account for that. I would then say year 0, disposal value or savings. You can call it matching disposal because of space, 30,000 naira. Now, when you say disposal means it's a cash inflow. When you dispose the machine, the company will earn income. The company will receive money. So once you receive money, that's a cash inflow. And that's why it is a saving. Therefore, since we are determining costs, the purpose of our calculation is on cost. Therefore, that saving of 30,000 naira will be in bracket, which will reduce the total cost of the company that the company will incur. So at this point, we need to calculate the discount factor at year 0 is usually 1. Discount factor at year 0 is 1. So 1 multiplied by 30 will give us 30,000. So put it in brackets. Let me rewrite this 360. All right then. So move on. Let's go back again to outsourcing. The third one is product and process engineering. We are told that year 1 only 8,000. Year 1 only products and process engineering cost of 8,000 naira for year 1 only. So I will then carry my calculator. I need to determine discount factor. Discount factor is calculated as 1 plus R raised to power minus N. Let me write it down for you, because I don't want to assume that you know it. So discount factor that is DF at 12%. So discount factor is calculated as 1 plus R raised to power minus N. So for year 1, it will be 1.12 raised to power minus 1. So bring out your calculator. Let's confirm. So 1.12 raised to power 1 minus equal 0.893. 0.893. So that's the discount factor. So let's go and put it there. Here is 0.893. So 0.893 multiplied by 8,000. 8,000 multiplied by 0.893 equal 7144. 7144. Okay. Then the last one under outsourcing is storage space. There's a saving on storage space per year, which is 2,000 naira per year. So year 1 to 5, savings, storage space savings. So that's a saving on storage space, which is 2,000. Because it's a saving, you have to put it in bracket to reduce your cost. So annuity factor year 1 to 5 is 3.605. So let's multiply that with 2,000. 3.605 multiplied by 2,000 equal 7210. 7210. So it's a saving. So at this point, I need to add up the total present value or the total NPV. Okay. Total NPV or PV under outsourcing. So bring down your calculator. Let's do the addition together. So I will say 360, 500 plus 7144 equal, then minus 30,000 minus 7210 equal 33434. Here is 330,434. So the total net present value under outsourcing is 330,434 naira. So I will then go again for option number 2, calculating present value of internal production. If the company wants to manufacture part 2011 internally, then what will be the present value or the net present value of that? It's the same way you did for outsourcing. So create a column for year, description of items, the cash flow, then the discount factor at 12%, then the present value. Now, if I like, I can list everything one by one to say I have direct material, I have direct labor, direct production labor, I have variable production overheads, variable production overheads. Then I also have product and process engineering costs, products and process engineering costs. The direct material cost is 44,000, 44, 42, 14, 8. So here is 44, 22,000, 14,000, then 8,000. These are the relevant costs the company will incur if the company wants to produce part 2011 internally. So we need to compare this. Before the comparison, we need to first of all determine the PV, total PV or total NPV of internal production. Therefore, year 1 to 5, the company will incur direct material costs. Year 1, 44,000. Year 2, 44,000 up to year 5. So all of them for the next 5 years. Therefore, on our discount factor, our annuity factor year 1 to 5 is 3.605. 3.605. 3.605. 3.605. So let us multiply together. I need you to help me multiply so that it can be faster. So somebody can start from year 5 or the last one. What do you have?
The first one, 158,620. Year 1. The first
Year 1,
one,
158.
direct material,
158,640, right?
620.
620.
620.
Okay, then. Let me do year 3. multiply by 14 equal 5470. Anyone again?
Direct labor,
Yeah.
79,310.
49.
79, 79.
Okay, 79310. Okay. Then product and process.
28,840.
28,840. Let's add everything together, please.
Three one seven 420.
317
420.
420. Okay, then. So the total present value of making part 2011 internally is 317,420 naira. At this point, I need to determine savings or deficit from making part 2011. I would then say saving or deficits from making parts 2011. So at this point, I need to compare the supplier's quotation with the relevant cost of making. I would then say supplier's quotation. I can call it supplier's quotation or cost of outsourcing. Supplier's, or let me call it option 1. Option 1, outsourcing, which is the supplier's quotation. We got 330,000. 330,434. 434. 434. Then option 2, which is internal production, that is relevant cost of making, the total present value of making part 2011 internally. So internal production, we got 317. Let me write that. 317, 420. 420. So what's the difference, please? The difference will represent a saving. What's the difference? 330, 330, 420. Sorry, 434. What do you get?
240. 317 240.
Yes. Is it 240 or 420? 317.
240.
Oh, okay. Thank you. So 240. So what's the difference? Give me the difference.
13,194.
13,194. So this represents a saving. Okay, this represents a saving. Therefore, I would then say, if I don't want to do it this way, if I want to do, before I even get my saving, if I want to follow a shortcut, if I want to do a shortcut, I can just do only one line item. I will just multiply the total relevant cost of 88,000 naira. I will multiply with 3.605. I will get the same present value of 317. This is what I'm trying to say. Alternatively, I can say, let me just manage it. Alternatively, I can say the PV under internal production, which is total relevant cost, is equal to, we got 88,000 naira. Yeah, 88,000 naira per annum. So I will just multiply by that one with 3.605 and I will get the same thing. So I will just say total PV of internal production equal to 88,000 multiplied by 3.605. I should be able to get the same thing as 317, 240. Yeah. So, but at times it's good for you to list everything the way we did previously, like this. Okay. But you never can tell if the examiner will mark it for you line by line, or the examiner is looking for the total number. So that's that. So let's move on. This is not the end of the question. So after that, we need to advise. So our advice should be that DG Limited should produce part 2011 internally in order to save 13,194 naira. So I need to make a decision. Divine Grace Limited should produce parts 2011 internally in order to save 13,184 naira. That's it. That's it. So we have just completed number A. So we're not going to hand it. We need to state our assumptions. We made some assumptions when we were picking the numbers. So please write it down. Let's talk about the assumptions. Let's go back to the question. Under the assumption, how do we arrive at under note number 1? In note number 1, we said that part 2011 is made on a machine used exclusively for the production of part 2011. The machine was acquired on 1st January at a cost of 120,000 naira. The machine has a useful life of 6 years and zero terminal disposal value. So what assumption did where did we ignore the 120,000 naira? So we need to state our assumption. So you are writing, please. Put it down. Assumption. The calculation above is based on the following underlying assumptions. Okay. Assumption. Even you can see, examiner did not ask you to state assumption, but there's no way you can earn your full mark if you don't state your assumptions, because there are some figures in the question that you ignore. Why did you ignore them? So you don't need the examiner to tell you before you know that you are supposed to state your assumption. So the calculation above is based on the following underlying assumptions. Okay. Number 1, you are writing machine. I will not write everything for you. Machine. So what assumption did you make under machine? So let's talk about machine. We just read the information there. So you are writing, please. It is assumed that the machine is owned by KKPLC Limited, KKPLC. It is assumed that the machine is owned by KKPLC. However, the original cost of the machine of 120,000 naira is a sunk cost and therefore ignored. Because of time. That's why I say you should write it down, but let me see what I can do. Okay. It is assumed that the machine is owned by KK PLC, which is the supplier. However, the original cost of the machine of 120,000 naira is a sunk cost and therefore irrelevant. It's a sunk cost and therefore irrelevant. Okay, that's that. Then number 2, what other assumptions we made in the question? We talk about depreciation. We are given a depreciation of 20,000 naira. So what assumption did you make? You are going to state that depreciation is a non-cash item and therefore not relevant to the calculation. So let's put it down. Depreciation this is a non-cash item excuse me. Okay. This is a non-cash item. Please mute yourself. And therefore not relevant to the calculation. Number 3, what other assumption did you make in the question? We ignore rents. So we are going to state that the cost of the rents, how much is the cost of the rents? Let me see, 8,000 naira. So the cost of the rent of 8,000 naira is an apportionment and not relevant to the calculation. So let's put it down. Rent. Because examiner told us that the rent is apportioned on the basis of a floor space. So anything apportionment is irrelevant. So the cost of the rent of 8,000 naira is an apportionment and therefore irrelevant. Okay, and therefore irrelevant. Number 4, any other assumption? Yes, I think, yes, we have general overheads. So again, the general overhead, according to the question, we are told that general overheads are apportioned to each department on the basis of direct production labor cost. Of course, anything that has to do with apportionment is irrelevant. So we are going to state that the general overhead, general fixed overhead is an apportionment and will be incurred irrespective of whether Part 2011 is produced or not. So it's not relevant. Let's put it down. Okay. Sorry, I need to. Yeah, general overhead, general fixed overhead. So the general fixed overhead is an apportionment and will be incurred irrespective of whether part 2011 is manufactured or not. Therefore, hence, general overhead is not relevant. Hence, the general fixed overhead is not relevant. Okay, that's it. So these are the, like you can do more than that, but this is okay. So let's quickly see if you can do the number 5. Before we close the day. Sorry, number B parts of the question. Question is asking what can you hear me, please?
Yes, sir.
Yes, I think my internet has started misbehaving. So let's quickly round up on this. Let me share my working notes again. Okay. So what we are saying now is that after we are stating the assumption in number B parts, examiner is asking what will be the maximum price that KK Limited should quote on the 1,000 unit to make the fine grades indifferent between outsourcing and internal production. What examiner is trying to say here is that you are supposed to determine the break-even point or sensitivity margin. Okay, you need to determine the sensitivity margin of supplier costs. Okay, you need to determine the sensitivity margin of supplying costs. So if that is the case, what are you supposed to do? Okay, so maximum price to quote in order to break even. Let's determine that. And that's where we are going to stop. And that will be the end of the question. So I will say maximum price to quote, number B, maximum price to quote to break even. What is the maximum price to quote in order to break even? That is to be indifferent between whether to outsource or internal production. Let me write break even in full because of those that will not be Because of those that will be reading. Where are you? Okay. To break even. So what are you supposed to do in this case? When we get to risk and uncertainty, it's a topic on its own. We are going to talk about sensitivity margin analysis. So we are going to talk about sensitivity margin. So, and that's what the examiner is simply asking you here, that what is the maximum price that the company should quote in order to remain indifferent between outsourcing the 1,000 units and also internal production. So we want to determine the break-even point, that is sensitivity margin of supplying cost. So when you want to determine sensitivity margin, it's supposed to be, your sensitivity margin is just the ratio of the NPV to the PV of the supplying cost. But let me just, because of time, let me just, so to determine the maximum price, the company should quote on the 1,000 unit to make DG indifferent between outsourcing and internal production. So there will be need for us to calculate the sensitivity margin of supplying cost of part 2011. Okay. So let me just put it down. To determine the maximum price, KK PLC should quote to make DG Limited indifferent between outsourcing part 2011 and internal production. Outsourcing part 2011. We'll put part 2011 and internal production. We need to determine the sensitivity margin. Okay. We need to determine the sensitivity margin of supplying part 2011. Okay. We need to determine the sensitivity margin of supplying part 2011. This is shown as follows. So I would then say sensitivity margin of supplying cost is calculated as net present value divided by the present value of supplying cost. All of this multiplied by 100 over 1. So I would then say the NPV is the savings we have achieved. Savings of 13,194 divided by the PV of supplying cost. Okay, let me go back there. Our saving is 13,194, which is the net present value in this case. Then PV of supplying cost is 150, no? Yes, 360 500 naira is the present value of the supplying cost, 360, 500 naira. So I would then say 360 divided by 360, 500, multiplied by 100 over 1. So what do you get? So I would then say 13,194, sorry, 13,194 divided by 360, 500 naira equal, multiply by 100 equal, so 3.66. Here is 3.66%. So you need to interpret this number. This means that our supplying cost can increase. Our supplying cost can increase by 3.66 before our decision will change. So our supplying cost can increase by 3.66 before the decision to make will change, because we want to determine what is the sensitivity margin to make the company indifferent between outsourcing and internal production. So at this point, since supplier's quotation is 100 naira per unit, so we can then say that the supplier's quotation of 100 naira per unit can fall by 3.66% in order to break even. That is, to be indifferent. Therefore, the maximum price that the company should quote to break even would be, let's do the calculation. Within the next 2 minutes, we are going to close the class. So I would then say, since supplier quotation for the 1,000 units is 100 naira per unit. Let me write that. Since the supplier's quotation is 100 naira per unit, is 100 naira per unit, then the break-even points, or I can then say the 100 naira will fall by 3 naira 66 kobo in order to break even. Since supplier's quotation is 100 naira per unit, this means that the supplying cost per unit will fall, or can fall by 3.66%. Can fall by 3.66% in order to be indifferent or break even. In order to be indifferent or break even. Okay, so if that is the case, we need to determine the price that the company should quote then. Therefore, the maximum price that the company should quote to break even will then be, let's determine that. Therefore, the maximum price to quote, to be indifferent, is calculated as follows. So let's do that. Oh, shit. Yeah, go back. Okay, that's it. Now, I would then say maximum price. Okay. The original supplier's quotation, supplying cost per unit is 100 naira. Supplying cost per unit is 100 naira. Therefore, we are saying that this price can fall by 3.66% price reduction. So the price reduction which is 100 naira multiplied by 3.66%. So this should give us 3.66 naira. When you less that should be 96.34. That should be it. Yeah. So that's the maximum price. That's the maximum price that the company should quote in order to remain in difference. So that's it. That's it. So we are done with the question. In number C, examiner is asking you what non-financial factor will favor internal production rather than outsourcing. So just mention the qualitative factors that you need to consider. You can say, okay, you can say that the following qualitative factor will need to be considered by the management of Divine Grace Limited before making the final decision. 1, do we have the required manpower to manufacture per 2011 in addition to the existing products? That's number 1 factor. Then number 2, Divine Grace Limited will need to ascertain if there's a requisite in-house technical know-how or expertise to produce the per 2011. You need to know whether you have the requisite know-how or expertise to produce part 2011. Not only that, number 3, you also need to ask, internal production may be favored over outsourcing to maintain better quality control to satisfy customer demand. Okay, so internal production may be favored over outsourcing in order to maintain better quality control to satisfy customer demand. Number 4, we also need to ask, do we have sufficient in-house storage capacity that can accommodate per 2011? Okay, so that question must be asked. If you list like 4 or 5, you should be okay. All right. So let me just add one more. And what should be the last one? Okay, you can say outsourcing per 2011 may result in labor disputes, which can impair the reputation of the company and if not properly managed. I repeat, outsourcing per 2011 may result in labor disputes, which can impair the reputation of the company if not properly managed. So I think I've given 5. So if you like, you can then include anyone you have in your material. Like you can also say that the impact of outsourcing parts 2011 on workers' morale should be considered because this can result to low productivity. Okay, I repeat, the impact of outsourcing Part 2011 on workers' morale should be considered because this can result to low productivity. So these are the things you need to, these are the factors you need to consider in relation to the to this question. So let me know if you have any question for me before we close the class for today. I've really extended beyond your required time of 11, so we've added additional 19 minutes. Sorry for that. We just have to complete this question so that we don't carry it over. That's why. I believe you understand. So let me stop sharing.
Sir,
Yes, talk to me.
so my question is the machine sold.
Yep.
In that additional information number two that says machine could be sold today for 30,000 naira. Why do we
Yeah.
have to outsource it instead of internal production? Since
That's
machine, okay.
yes, that's our assumption. You know, you can see in that question, the examiner did not tell you who owns the machine. Is it the company? Is it Divine Grace that owns the machine or KKPSC? We are not told. So you need to take a position. So our assumption is that it is KKPSC that owns the machine, and that's why you see in the assumption I mentioned to you, we assume that the machine is owned by KK PLC. However, the original cost of the machine of 120 is a sunk cost. Okay. So our assumption is that it is the supplier that owns the machine.
All right, sir. All right.
Yep. Yes. Any question before we close the class?
I have a question.
Yeah, Tony, talk to me.
It has to.
I can't hear you, Tony.
Can you hear me now, sir?
Yes, better.
I say for the assumptions,
Yep.
for exam purposes, do we have to include both the item that's relevant and the item that are not relevant? Because the items you listed on the assumptions are basically items that are not relevant.
Yes.
So I'm asking, on the example purpose now, do we have to itemize both those relevant and those not relevant as part of the assumptions?
Yes, it all depends on you. Like I mentioned to you, it all depends on you. If you have the time, the focus
Okay.
is that the numbers that you ignore, why did you ignore? That's the primary focus of your assumption. Because the one the one you accounted for in the question, examiner can see it, but the one you
Okay.
ignore, examiner cannot see it. So, but in
Okay.
any case, if you state the two, if you comment on the one you ignore and the one you also accounted for, so there is no problem as per that. So if you have the liberty, if you have the time to do all of that, no problem. Examiner will also mark it for you. But the bottom line is that the target is on the figures that you ignore in the question. Why did you ignore it? Okay.
Okay.
So that's why
Okay,
we restrict our assumption to those ones. But if you do the two, you're
okay.
fine. Yeah.
Okay. So on the closing note, sir, the other
Yep.
lecturer, Mr. Siwaji,
Yep.
I think we've not received the last lecture and the other upper lecture, the link. I don't know.
No,
You
it
know
has
why?
been shared. It has been shared. I will also need. I need to check it. I think it has been shared, but I will confirm. In any case, I will confirm. All right.
Okay, sir. Thank you very much, sir.
You mean the lecture Mr. Shiwaji took you guys on Friday, last Friday? Sorry, on Thursday.
Thursday, yeah.
Okay, I will find out. I will find out. No worries.
Thank you, sir.
You're
Thank you,
welcome.
sir.
So in the
That's all for
absence
now.
of in
Yeah,
the
sir.
absence,
Just
okay, Victor.
yes, sir. Yeah, it's about the group chat. So I'm yet to be added to the group. So
Okay, send me the WhatsApp chat.
okay, sir.
Just send me a WhatsApp chat.
Okay, sir.
All right. Okay. So in the absence of no other questions, so this is where we are going to close the class for today. By the grace of God, next week, Monday, I will be introducing you to, we are going to start optimal product mix decision. Therefore, I need you to go ahead and read about optimal product mix. Latest tomorrow, by the grace of God, I will share the material with you so that you can have something to go through. All right. So before we start optimal product mix next week, we still have one more area we need to look at under short-term decision, which is the acceptance or rejection of a special order. So within our first 1 hour, we are going to complete that. Then we'll move to optimal product mix. So thank you guys for your time and understanding. See you again next week by the grace of God. Good night.
Yes, sir.
Thank you.
That's-
Good night.